Starting a venture capital fund can be one of the most powerful ways to invest in the future of innovation. But launching a VC fund isn't just about finding great startups. You'll also need to understand how startups are valued, how exits happen, and how investors actually get paid. In this video, we're going to walk through the fundamentals of starting a venture capital fund, including basic valuation methods, typical exit strategies, and how venture capital investors receive their returns. Hey, it's Frank Nagy. Welcome to my channel where we help financial entrepreneurs grow their business in the financial markets. If you're new here, subscribe to my channel and hit that like button. A venture capital fund pools money from investors and invests its early stage companies with high growth potential. Typically, a venture capital fund has two main groups: the general partners or GPs. These are the fund managers. They find the deals, evaluate the startups, and manage the investments. And then there's the limited partners or the LPs. These are the investors who provide the capital. LPs can include family offices, high net worth individuals, institutions, and sometimes other pension funds. A typical venture capital fund structure lasts about 10 years, but that's not set in stone. The timeline looks at the following. It's usually 1 to 3 years raising capital and investing in the startups. Then 4 to 7 years is helping the companies grow. And then 7 to 10 years exits and returns the capital to the investors, and hopefully with a profit. VC funds typically charge about 20% carried interest, meaning the managers receive about 20% of the profits after the investors receive their capital back. Valuating startups is different from valuating mature companies because many startups have little to no revenue or profits. Instead, venture capitalists rely on several approaches. Number one, comparable company analysis. One common approach is comparing the startups to similar other companies that have raised funding. For example, if a software startup in a certain sector 10 times annual revenue and a startup generates $2 million in revenue, it might be valued at around $20 million. Number two, venture capital method. Another approach is working backwards from the expected exit value. For example, if a VC expects the company to sell for, say, $200 million in 7 years, and the fund wants 10 times return, the fund might invest when the company is valued at around $20 million post-money. Number three, market opportunity and growth. Many early stage valuations are also driven by market size, team quality, product traction, and a competitive edge. In venture capital, investors are essentially betting that a small percentage of the companies will produce a massive return. Hiring experienced hedge fund consultant like Frank Nagy Financial Services will greatly reduce the burden of setting up your hedge fund or venture capital fund or offshore broker-dealer. A good consultant will make the appropriate reductions with fund administrators, auditors, attorneys, banks, and other institutions that will help your fund grow. Venture capital returns usually come from three primary exits. Number one, acquisition. The most common exit is when a larger company acquires the startup. For example, a mature technology company may acquire a smaller startup to garnish its product, customers, or engineering talent. Number two, initial public offering or IPO. In some cases, a startup grows large enough to go public through an IPO or a mini IPO under Reg A. This allows venture capital investors to gradually sell their shares in the public market. And number three, secondary sales. Sometimes venture capital funds sell their shares to other investors during later funding rounds. This allows early investors to lock in gains before a full exit. Because venture capital investing is risky, venture capital funds rely on only a few large winners and the overall performance. One successful company can return the entire fund. When exits occur, proceeds are distributed through something called a waterfall structure. Typically, the payout order looks like this. Number one, a return of capital. The limited partnerships receive their investment back first. Number two, a preferred return. Some funds include a preferred return for investors or a pref. And number three, a profit split. Remaining profits are split between the investors and the fund managers. And a common split is typically 80% for the limited partners, and 20% of carried interest is to the general partners. An example is a venture capital fund raises $50 million and ultimately returns $200 million. The profit will then be distributed after investors receive their initial capital back. This structure aligns the incentives of the fund managers and the investors. Starting a venture capital fund requires more than just capital. It requires understanding of startup valuation, exit strategies, and how investor returns are to be structured. Hey, if you'd like to learn more about Frank Nagy Financial Services and how we can help set up and structure your hedge fund, click on the links below in the description box.